I wonder whether any of you have noticed, but during the last 6 months, Warren Buffett has been extremely quiet. He has made very few adjustments to his portfolio and no public appearances. The man has avoided the limelight to such an extent that it was difficult for him to deal with Charlie Munger's untimely death in November of last year. Buffett released a brief 2-line statement expressing gratitude to Charlie for his inspiration, knowledge, and involvement. However, the moment has come for Warren Buffett to speak out, as he did recently in his annual letter to shareholders, paying respect to Charlie Munger in a fitting manner and offering some insightful financial advice for the upcoming year. But first things first, the entire first page of the paper is devoted to paying tribute to Charlie Munger, and Buffett says some incredibly wonderful things about his former business partner. Keep in mind that these two have been close friends since 1959 and were essentially best friends. Warren Buffett's remarks about his friend begin with a discussion of how the two first got together and Charlie's early counsel to Warren to concentrate on the quality of the company rather than the Ben Graham cigarette butt approach. However, he then continues and discusses Charlie's real participation in Berkshire, noting that in actuality, the current Berkshire was designed by Charlie, and I carried out the day-by-day construction of his vision in the role of general contractor. In a way, Charlie's relationship with me was like that of an older brother and loving father. Even when he knew he was right and gave me the reins, he never pointed out my mistakes to me. In the real world, great buildings are associated with their architects, but the people who laid the foundation or put in the windows are quickly forgotten. Despite my long-standing leadership of the construction crew, Berkshire has grown into a great company. Charlie deserves to be recognized as the architect throughout eternity. That's a very lovely homage to Charlie, in my opinion. Buffett's remarks are very encouraging to hear, even though I believe Charlie never received enough credit for his work at Berkshire. With that said, let's get into the letter's actual contents, which have a lot of important information. He began by making his customary jab at the relatively recent changes to accounting standards that require unrealized capital gains to be included in net income. For most companies, this is acceptable, but for a company like Berkshire, which consists primarily of wholly owned business operations plus a massive stock portfolio, it implies that evaluating the true outcomes of the underlying business activities can be challenging due to the stock market's month-to-month fluctuations. He claims that when you ask for advice, you are informed that the standards for determining these profits are set by the Financial Accounting Standards Board, which is a sober and qualified body mandated by the Securities and Exchange Commission, and that the Financial Accounting Standards Board is audited by the elite experts at Deloitte and Touche. But we are uneasy at Berkshire because we believe that profits should be a reasonable notion that Bertie will find somewhat helpful, but only as a beginning point for assessing a business, and that reference to Bertie is now simplistic. Buffett stated that he liked to write these letters in a way that the average shareholder can understand. However, based on that passage, it's clear how irritated he is with these rules. For instance, if a company makes $10 billion, $20 billion, and $30 billion annually, that's great. However, if they own an investment portfolio that increases by $5 billion in the first year, decreases by $5 billion in the next, and then drops by another $10 billion in the third year, it will appear as though the company's earnings are stagnating when, in reality, it has expanded its business operations. Companies that primarily manufacture and sell electronics and don't hold many investments are not particularly affected by this rule. Instead, stock prices are just fluctuating in the short term. However, simple unrealized capital gains can actually swing the official numbers quite a bit for a company like Berkshire, which has a large number of wholly owned businesses and a $350 billion stock portfolio. In fact, Buffett notes that this can swing Berkshire's net income by up to $5 billion per day. Buffett suggests that the solution is to always monitor operating income, which indicates how much money the business operations are actually making. That was the first thing Buffett discussed, but he also took the time to go through his investment strategy and what he specifically looks for when purchasing a stock. He made 2 important notes. First, he always looks for companies with strong fundamentals and longevity in the economy. And second, he hopes that these companies are managed by capable, and trustworthy individuals. As is typical with Buffett, this involves analyzing the company for a remote and then making sure that the company is managed by trustworthy individuals. He also notes how difficult this seemingly simple strategy is actually becoming for Berkshire, and this was probably the most fascinating part of the letter for me. As I've mentioned, buying firms has always been our main objective, and for a while there were a lot of applicants to consider. If I missed one, there were always plenty more to come along. But those days are long gone. Size did us in, albeit there was also more competition for goods. You heard correctly. Warren Buffett, the Oracle of Omaha, has acknowledged that Berkshire's incredible run is likely coming to an end because the company is simply too large. But why is scale such a problem? Well, he quotes, saying that there are still very few businesses in this nation that can actually make a significant difference at Berkshire. Of billions. As of the recording date, there were only 92 companies in America with a market cap that high. Furthermore, it goes without saying that as you venture abroad and distance yourself from the world's largest stock market, the opportunities diminish. That being said, Buffett is still hopeful about uncovering these chances because psychology is one more element that will always exist and provide investors with exceptional but rare opportunities. Buffett claims that occasionally the economy and/or markets may result in certain huge, fundamentally sound companies' stocks and bonds being glaringly mispriced. He also claims that markets can and will suddenly collapse or even disappear, as they did for a few days in 2001 and for 4 months in 1914. If you think that American investors are more secure today than they were a few years ago, think back to September 2008 and realize how far we have come. The speed of communication and technological wonders allow for instantaneous global paralysis. People say that the stock market could never crash again like it did in the 1920s or in 2008. But I do agree with Buffett that it's actually easier for the stock market to suffer heavy losses very quickly in today's environment because of the accessibility of the markets to everyone. Panic can ensue faster than ever before, and it will undoubtedly cause market crashes in the future. Since smoke signals such instant panics won't happen often, but they will happen a lot. But the secret is to maintain your composure, recognize which are the high-quality companies, and keep a close check on them on your watch list, so that when the markets eventually collapse, you will be ready to act decisively in the long run. Buffett observes that even though the stock market has grown significantly since our early years, active investors today are neither more emotionally stable nor more well-educated than they were during my school years. For whatever reason, markets today display a lot more casino-like behavior than they did during my childhood. The casino now occupies many homes and daily tempts the residents, which ultimately highlights the game we play as long-term investors. That's really all there is to it. However, you must maintain your rationality. He continues in his letter to discuss his number one investment rule, stating that one investment rule at Berkshire has not and will not change. Instead, you should wait for Wall Street and the gamblers to panic buy the great stuff during the short-term drop and hold it for the long-term recovery. The market we operate in has been and will continue to be rewarding if you make a few wise decisions during your lifetime and avoid making big mistakes. Thanks to the American tailwind and the power of compound interest, you never have to risk irreversible loss of cash. Basically, avoid joining the gamblers and always consider the big picture while making judgments. However, that quote in particular highlights a point that I've been harping on about a lot lately. Focus on sticking with those few wise selections over the long haul. Buffett continues his discussion of compounders and the need of hanging on to long-term compounders with 2 instances. American Express and Coke. He claims that Coca-Cola debuted in an Atlanta drugstore in 1886, and that American Express started operations in 1850. Berkshire is not a fan of newcomers. Both businesses have attempted, but failed, to grow into other fields throughout the years. This is clearly not the time to try this. Despite even being poorly run, both had great success in their original businesses, which were redesigned here. The consumption of liquids and the need for unwavering financial trust are timeless essentials of our world. In 2023, we neither bought nor sold a share of either American Express or Coke, prolonging our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies were rewarded out in action last year by increasing their earnings and dividends. In fact, our share of Amex earnings in 2023 significantly exceeded the $1.3 billion cost of our long-ago purchase. Furthermore, both Coke and American Express became recognizable names worldwide as crucially their products traveled. The consumption of liquids and the need for unwavering financial trust are timeless essentials of our world. In 2023, we neither bought nor sold a share of either American Express or Coke, prolonging our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies were rewarded out in action last year by increasing their earnings and dividends. In fact, our share of Amex earnings in 2023 significantly exceeded the $1.3 billion cost of our long-ago purchase. Furthermore, both Coke and American Express became recognizable names worldwide as crucially their products traveled. These are my key takeaways from Buffett's annual shareholder letter. He has made hundreds of investment decisions over the years, but he claims that his entire success comes down to roughly 12 of them. If it stays strong, keep it locked in your portfolio. That's really it. The success of your entire investing career will probably come down to 3 or 4 stocks that you just held onto through thick and thin. If held for a long time, those stocks will take care of all the other mediocre decisions that you make. Hopefully, your continued presence indicates that you will adopt Warren Buffett's investing strategy. In conclusion, as we navigate the financial landscape of 2024, Warren Buffett's timeless wisdom continues to be a guiding light for investors. His emphasis on long-term value, patience, and a thorough understanding of the businesses we invest in remains as relevant as ever. In a world that is often driven by short-term trends and market fluctuations, Buffett's steadfast approach encourages us to stay focused on the fundamentals and to approach investing with a rational mindset. So whether you are a seasoned investor or just beginning your journey, remember the sage advice of Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. As we move forward in the dynamic world of investing, let Buffett's principles serve as a compass, helping you navigate the complexities of the market and make informed decisions that stand the test of time. Happy investing, and may the lessons from one of the greatest investors of our time guide you towards financial success in 2024 and beyond. If you found Warren Buffett's insights valuable and want to stay updated on the latest trends, strategies, and expert advice in the world of investing, don't forget to hit the like button, share this video with fellow investors, and subscribe to our investing tutorial channel. By subscribing, you ensure that you never miss out on future content that can empower you on your financial journey. Join our community of like-minded individuals committed to building wealth, making informed investment decisions, and achieving long-term financial success. Thank you for your support, and we look forward to bringing you more enriching content in the world of investing.